Hi guys, this is Mr. Tan, and today we're looking at business strategy, and we're looking at additional business strategy options or strategic options that you have for your organization or company, and then really trying to justify that selection of that strategy. So let's have a look at some of these. So we've got disinvestment strategy. So what are disinvestment strategies? Disinvestments, also known as divestments, are processes utilized by organizations when there is a need or desire to initiate a reduction in capital investment. Essentially, it is the polar opposite of an investment. The process of disinvestment involves selling off current investments in order to generate assets that can be used to better advantage in some other manner. So businesses sometimes use disinvestment as a means of changing the direction of the company in order to meet the changing, consumer needs and remain competitive. And even if we think about disinvestment, we can think of it in terms of companies which may have different arms and different, SBUs, strategic business units, or different companies attached to their parent company. And if you think regarding the BCG Boston Consultancy Matrix in terms of what we've looked at, then you can say to yourself, is a strategic business unit a rising star? Is it a question mark? Is it a cash cow or is it a dog? And sometimes, if business investments are dogs, you may have a strategy of disinvestment to get rid of that dog. So one of the easiest ways to understand disinvestment is to think in terms of a company that has successfully produced a product for many years. However, changing technology is shrinking the demand for that company's product. A new product is developed that is anticipated to recapture the interest of consumers. However, this will leave the company with several physical facilities and a great deal of equipment that is not required for the production of the new product. And in order to generate revenue, that will aid in the manufacture of this new product, the company will need to undergo a period of disinvestment. The plants and other facilities that are no longer required for production are sold off, along with the new obsolete equipment. So in this respect, we're talking about disinvestment into product ranges. So it can be disinvestment from a higher level in terms of company units, strategic business units, or even if we think about product ranges in companies, and we still put those product ranges within the BCG matrix. BCG matrix as regards to the question marks, stars, cash cows, and dogs. And again, we can see a change in direction in terms of a specific type of or a new product could mean no longer carrying out the production facilities of an existing product. So you're going to disinvest into those activities, but that will require also disinvesting into some processes, plant, machinery and equipment, and so on and so forth. So what is retrenchment? Retrenchment is to cut down or reduce something, to tighten one's belt, to use resources more carefully. Retrenchment is the act of reducing expenditure in order to improve financial stability. So retrenchment, is a strategy, is the process whereby you reduce the size and scale of your organization's operations. If we think about Tesco's, when Tesco's went into retrenchment, we can see that they closed down some of their central distribution centres within the UK as a form of retrenchment to cut down on the size of their operations. Even if we think about a lot of businesses now, and we think of loads of retailers out there, retailers face extreme competition from those online retailers. Retailers who just have an online store, or retailers that have both, their presence and an online store. So, a lot of retail companies now can't compete, and so they're having to retrench. And retrenchment in terms of reducing the number of stores that they have, even reducing the stores that are not profitable. And we've seen this many times as well, especially in the ladies' fashion industry. So, what drives retrenchment? You know, uncompetitive cost structures, inadequate returns on investment, poor competitive position, financial difficulties, market decline, economic downturn, change of ownership. All of which may be well indicate the need for strategic change. So, again, you have to look at the competitive business and the competitive marketplace, what the competitors are doing, new competitors, and how this is affecting your bottom line. Even again, if we look at retrenchment in terms of Tesco's also reduced some of their stores for the stores which were non-profitable. Methods of retrenchment: reduced output and capacity, reduced staff, product and market withdrawals, downsizing, disposal of business units. So, if you can think in your groups using the internet lists, 6 companies that have disposed of partner businesses for less than they bought it for. Can you think of 6? Can you list down 6? So it's an exercise for you to do individually. So disinvestment. So when we come back to disinvestment, in finance and economics, disinvestment is the reduction of some kind of asset, for either financial or ethical objectives, or sale of an existing business by a firm. And when we think about disinvestment, what are the reasons why people might go for a disinvestment as a strategy? It might be because the market's too small. It might be because availability of better alternatives, the need for increased investment. It may be not a very good strategic fit now, and it may be legal pressures to divest and disinvest. So, and as we've said, a disinvestment is the opposite of investment. When a business environment and its business, position are not favourable, then an organisation can expect to see disinvestment or liquidation. So let's look at liquidation. So if we look at liquidation, this is when a business or firm is terminated by bankruptcy, assets are sold, and the proceeds pay creditors. Any leftovers are distributed to shareholders. And again, with liquidation and the Liquidation Act, they will follow specific guidelines in terms of who would be paid first, and so there would be a line of order of people who would be paid. So what are some of the reasons for disinvesting? So barriers to disinvestment. So barriers to disinvestment includes, that prevents a market from wanting to leave the market, include knowing specialized assets such as some of the machinery have little value, to other organizations. Long-term contracts with suppliers may be difficult to break. The organization may have, a commitment to provide spare parts and service back up to retailers and customers. And there also might be government restrictions, can effectively prohibit an exit decision. Rail service, for example, can. Some additional barriers to disinvestment include cost barriers, including redundancy costs. Managers may fail to grasp the idea of decision relevant costs. We spent all this money, so we must go on. Marketing considerations may delay withdrawal. A product might be a lost leader for some others, but it might contribute to the company's reputation for its breadth of coverage. Again, you have a width of product range, and sometimes you keep the products in even if they are the dog. And then also, Managers hate to admit failure, so they don't want to disinvest because it's a form of failure. So the other thing to bear in mind is that once you're looking at these strategies, you need to bear to evaluate it, and there are various criteria that need to be taken into consideration when you are evaluating these strategies, and these include whether they are suitable, whether they are feasible, and whether they are desirable or acceptable. So in your groups or individually, you can think about what is suitability. What does that mean to you, or what's the definition of this in terms of a company perspective? What do we mean by feasibility in terms of disinvestment or retrenchment strategies? And what about desirability? So again, what does this mean to you in terms of the company strategy that you want to opt for in terms of either liquidation, disinvestment, or retrenchment? So suitability, the strategy should fit the situation of the firm. It should satisfy a range of requirements, including, you know, exploit company strengths and competences, rectify company weaknesses, help the firm to seize opportunities, satisfy the goals of the organization, generate, maintain competitive advantage, involve an acceptable level of risk, and suit the corporate culture. Feasibility asks whether the strategy can in fact be implemented. This will depend upon the capabilities of the organization, and strategies which do not make use of existing competences and which therefore call for new competences to be acquired might not be feasible, since gaining competences takes time and also can be costly. Desirability. So the desirability of a strategy relates to people's expectations of it. It is here the stakeholder analysis can be brought in. A stakeholder analysis in terms of financial considerations. Strategies will be evaluated by considering how far they contribute to meeting a dominant objective of increasing shareholder wealth. Customers, may object to a strategy if it means reducing a service, but they might have no choice. Banks are interested in the implications for cash resources, debt levels, and so on and so forth. Government, a strategy involving a takeover might be prohibited under the competitive legislation, in the UK and in the EU. The public, the environmental impact may cause key stakeholders to protest. Out-of-town superstores, are now frowned upon. Risk, and different stakeholders have different attitudes to risk. A strategy which changes the risk and return profile for whatever reason may not be acceptable. So thank you for today. We're looking at disinvestment, retrenchment strategies, and different options which are available to you. But also you need to bear in mind, is it a best fit? The reasons why companies want to take a different strategy, a different line, in line also with the BCG matrix, and also barriers to disinvestment and retrenchment strategies. So thank you today from Mr. Tan.